Welcome back to Management 416. In this video lecture, I will be covering Capstone's Finance Decision Spreadsheet. A lot of students are most intimidated by the finance spreadsheet, but I personally find it the easiest one. Once you have decided what you will do in R&D, marketing, and production, you will need to figure out how you will pay for your big ideas. That is what the finance department is for. To illustrate the finance worksheet, I went back to the production worksheet and I made some investments in my plant. I increased automation for Able from 4 to 6 and for Acre from 5 to 7. Remember, if I invest in automation this year, I will be able to use it next year. I just make these investments for illustrative purposes, and you should not blindly copy them. Your round one investments will probably look different and can include the purchase or sale of capacity, increases in automation for any of your product lines, and potentially investments in the design of new products. You can see here that increasing automation for Able from 4 to 6 will cost us $14,400,000. Increasing automation for Acre from 5 to 7 will cost us $11,200,000. The total investment required is $25,600,000, as depicted here. I decided to make these illustrative investments for the finance lecture because investing in your company requires financing and therefore will affect your finance decisions. This is the finance decision spreadsheet. You can see that it will copy the value of total investments that was also displayed in the production worksheet. It also depicts any proceeds from the sale of plant and equipment, which would give you cash that you could reinvest and which would reduce the financing needed for your investments. Since my decisions did not include the sale of any capacity, I do not have any proceeds here. The next section covers issues related to common stock. In this section, your company can issue stock, retire stock, as well as issue dividends. As a general rule, stock issues are used to fund long-term investments in capacity and automation. You should not issue stock to cover negative profits, for example, or deal with a cash shortage because of inventory increases. Shares outstanding displays the number of shares of common stock in the hands of shareholders. At the start of the simulation, each company has 2 million shares outstanding. Price per share indicates the stock price as of yesterday's close. Stock will be issued or retired at this price. At the start of the simulation, each company's share price is $34.25. Earnings per share are this year's projected earnings per share, defined as pro forma profits divided by common shares outstanding. The simulation has not been processed, so we don't know our actual profitability. Remember that these are projected earnings per share based on the decisions that you have put into the simulation. The maximum stock issue gives you the dollar amount of new shares your board of directors has authorized for sale to the public this year. The maximum stock issue for round one is $13,700,000. You can issue up to 20% of the outstanding shares each year. Pause the lecture to figure out how many shares you can issue if you have 2 million shares outstanding. If you have 2 million shares outstanding, you can issue a maximum of 20% of 2 million, which is 400,000 shares. At the price of $34.25 per share, what is the maximum amount you can raise through stock issue? 400,000 shares times $34.25 per share gives us $13,700,000 as the maximum dollar amount we can raise. Capsim displays the maximum stock issue of $13,700,000 that we just calculated automatically. In the issue stock field, you would enter the amount of money that you would like to raise this year by selling common stock to the public. You are limited to the amount in the maximum stock issue. There is a 5% brokerage fee for issuing stock. The maximum stock retire is the limit set by the board of directors upon stock repurchases this year. The maximum stock retire is $3,425,000 for round 1. You can retire up to 5% of the outstanding shares each year, but not more than the total equity of your company. For example, suppose you have 2 million shares outstanding. The maximum number of shares you can retire is 5% of 2 million, which is 100,000. At a stock price of $34.25, this would cost you $3,425,000. If you decide to retire stock, you cannot exceed this limit, nor can the amount exceed the total equity of your company. Just a reminder that Capsim displays the maximum stock retire of $3,425,000 that we just calculated automatically. In the retire stock field, you enter the amount that you wish to spend to purchase outstanding common stock from shareholders. You are limited to the amount in maximum stock retire. Since you are a public company, you can also decide to issue dividends. Enter the amount of money you plan to give shareholders this year as an annual dividend under dividend per share. Entering $1 means that you will give each shareholder $1 for each share they hold. Suppose there are 2 million shares outstanding. Your total outlay for a $1 dividend would be $2 million. You should not issue a dividend that is greater than earnings per share. You will be extracting equity and giving it to the shareholder. It may be interesting to issue dividends later on in the simulation when you have excess profits. The next section covers current debt. You are able to issue current debt, which consists of 1-year banknotes. Current debt is normally used to fund short-term assets like accounts receivable and inventory. You should not fund long-term investments in capacity, automation, or new products with current debt. In the current debt section, you can see the interest rate for current debt here. Interest rates are a function of your leverage. The more leveraged your company is, the more debt it has related to assets. This increases the risk you represent, and therefore the interest rate will be higher for more leveraged companies. The next section displays due this year, and this is really last year's current debt. You always have to pay it off on January 1st. Since you have to pay your current debt this year, it will be automatically reflected in your end-of-year cash position. Under Borrow, you can enter the amount that you want to borrow as current debt this year. The amount of current debt you can borrow is determined by how much you have in accounts receivable and inventory. The next section displays your company's cash position at the end of the previous round and the projected cash position at the end of the current round. How accurate this projected cash position is depends on how accurate your sales forecast is, which is the basis for all the pro forma values provided by the simulation. You want to make sure that your projected cash position is not negative to reduce the likelihood of you needing an emergency loan from Big Al. You can see that right now we are projected to be $22 million in the negative. And this is due to these investments that we are doing, but which we have not yet funded either through debt or equity. Your company can also retire and issue bonds. All bonds are 10-year notes. You can retire bonds before they mature. When you retire bonds before their due date, your company has to pay a 1.5% brokerage fee. You can also issue bonds. The interest rate for bonds is displayed under long-term interest rate and is 1.4% above current debt interest rates. When you issue bonds, your company has to pay a 5% brokerage fee. As a general rule, bond issues, like stock issues, are used to fund long-term investments in capacity and automation. Bondholders will lend a total amount of up to 80% of the value of your fixed assets. You can find this amount under maximum issue this year. You can also see that you can adjust accounts receivable and accounts payable in the finance spreadsheet. Your company has some outstanding bonds that will come due in the next few years. Please note that these dates may be different on your interface, and these are just for illustration. The series number identifies the bond issue. You can see the bond notation here. The first 3 digits are the interest rate. The S stands for series, and the last 4 digits are the year in which the bond is due. Remember that all bonds are 10-year notes. I recommend that you pause the video and try to complete the blanks here. If the face amount of bond 14S 2026 was 1 million, then the holder of the bond would receive $140,000 every year between 2016 and 2026 and a $1 million payment at the end of the 10th year. We just covered the series number. Remember that these dates may be different in your interface, and these are just for illustration. In the outstanding bonds section, you can also see the face amount, current yield, and 2020 closing price. The face amount is also called the principal. This is the amount that needs to be repaid when the bond matures. The bond's yield is defined as the return to an investor from the bond's coupon and maturity cash flows. It is the cash flows that come from the interest payments plus the closing price. If the yield is higher than the original interest rate on the bond, that means your company has a lower credit worthiness and therefore is higher risk than it was when it issued the bond. If the yield is lower than the original interest rate on the bond, that means your company has a higher credit worthiness and therefore is lower risk than it was when it issued the bond. The closing price or street price depicts how much you would pay for every $100 of face value if you wanted to retire the bond today. The street price is determined by the amount of interest the bond pays and your credit worthiness. Because your company's credit worthiness varies over time, the street price and the face value are likely different from each other. Falling interest rates make bond prices rise because it means the company is more creditworthy. The interest rate expected by the current bond market is therefore lower than the bond's stated interest rate, and the bond therefore would be sold at a price premium. Rising interest rates make bond prices fall because it means the company is less creditworthy. The interest rate expected by the current bond market is higher than the bond's stated interest rate. The bond therefore would be sold at a price discount. You can see that your company has 3 outstanding bonds that will mature over the 8-year decision frame of the simulation. When the bond matures, it is automatically converted into current debt. You will need to pay this current debt the year after the bond matured. Rather than waiting for bonds to mature, companies with extra cash can choose to buy back outstanding bonds before their due date. You will have to pay the closing price in the year you decide to buy back any outstanding bonds. Bonds are retired in the order they were issued. Financial transactions are carried on throughout the year directly from your cash account. If you run out of cash, you will need an emergency loan from Big Al, for which you will pay current debt interest plus a 7.5% penalty fee during the year you incur the emergency loan. Emergency loans automatically combine with current debt, and the total amount will be displayed in the due this year cell under current debt. Emergency loans depress stock prices even when you are profitable. Stockholders take a dim view of your performance when they witness a liquidity crisis. Emergency loans often occur when you have forecasted too high and end the year with a big inventory, or when the finance department did not raise long-term funds for capacity and automation through bond or stock issues. Remember the importance of having a strategy for your company before you start making decisions. You can find the 5 strategies and tactics to implement these strategies in the online help guide. A company pursuing a broad cost leader strategy will finance investments primarily through long-term bond issues, supplementing with stock offerings on an as-needed basis. The cost leader strategies primarily utilize long-term debt because cost leaders are not debt averse and prefer to keep leverage between 2 and 3. One of the reasons that they are not debt averse is because the key to a good cost strategy is to lower cost of production and maintain high margins. In order to do so, this strategy recommends to increase automation levels. The company will supplement this long-term investment into the company with long-term debt. Now let's go into the finance decision sheet and make some decisions. I logged in and I'm going to click on Capstone. And then I will go to decisions and launch the web spreadsheet. First, let's go to production. And you can see here that my decisions to change automation for Able and Acre are still here, with a total investment needed of $25,600,000. Let's go to the finance worksheet. The main thing that I'm concerned with is that I have a positive cash position at the end of this year and that I appropriately fund my long-term investments. We discussed how long-term investments should be funded with bond or stock issues. Depending on the strategy that you will pursue, you may wish to fund these investments with more stock versus long-term debt. However, it is good to keep some kind of balance between the two. Let's say that I decide to fund the total investment of $25,600,000, half by issuing stock and half by issuing long-term debt. So I would issue stock for $12,800,000 and I would also issue bonds for $12,800,000. When I recalculate this, you can see that my end of year cash position is now positive. And we have appropriately funded our long-term investments with bond and stock issues. Later on in the simulation, if you have excess cash, you can choose to retire stock, issue dividends, or retire bonds. If you think you're going to see an increase in accounts receivable or your inventory, you may borrow current debt to pay for that. You can also change accounts receivable and accounts payable, which we have covered earlier. So that's the finance spreadsheet. Now it's time for you to start making decisions. Good luck.